This conference will now be recorded.
Hello, I would
Unmuted.
sorry, back. Hold on just a second. All right, I think that should be better now. Hello, and I'd like to welcome you to the First Advantage VHDA First Time Homebuyer webinar with David Wright tonight. The presentation will be in listen-only mode, which means you will not be able to interact with the speaker verbally. Please keep yourself muted throughout the presentation, and at the end of the session, we will open the floor for questions. So please use the chat feature to ask your questions and type those in, and that feature is at the bottom of the screen for you. And without further delay, I'd like to introduce David. David, are you ready?
Yes, ma'am. Thank you, Amber, and thank you all for coming out and taking time out of your busy days to attend. So tonight we're going to talk about some of the basics of buying a home, and particularly some of the products that first-time home buyers generally use. So we'll kind of jump right in, and I look forward to your questions, and we will answer all of those at the end, but we will keep track of those as we go. So typically the home buying process kind of starts with defining your needs. This would be things like, what type of house do you want? How many beds and bathrooms do you need? What neighborhoods do you want to be in? Generally, what you want to do is get pre-qualified first, so that you have that part out of the way and you don't have to worry about what you can buy. We'll talk about how to do that later. Then you would choose an agent, a real estate agent. Now, the reason you want to do that is when you buy a home, the seller generally pays for the commission for the buyer's agent. So you would not typically pay for that agent, their commission, and you would want to pick an agent because their job is to help you with the contract and to represent you throughout the entire process. So very important to do that, but you want to get pre-qualified first if you can, but also be looking at picking an agent at that point as well. Along the way, once you get pre-approved and so forth, and you've got your agent, then of course they're going to help you go out and look at homes. You've seen lots of TV shows where the agent shows a person 3 homes and they pick one and they get it. It doesn't always work exactly like that. The TV show wraps up in 1 hour, and normally the home buying process can take a little longer than that. But once you've gotten pre-approved, you've picked an agent, then it's time to go looking for a house. Now, once you find one, then you will write a contract, and we won't go into great detail about how contracts are written or the ins and outs, but you would write a purchase contract, assuming it gets accepted. The steps along the way are the home inspection, which is where a home inspector comes in and basically goes through the house from top to bottom, attic, possibly crawl space, looks at all the HVAC, etc., and determines, hey, I think these are the things that need to be fixed, or these are the things that are going to be breaking in the following, the roof is only good for 5 more years, that kind of thing. So in that home inspection, then you would negotiate those repairs from the seller. And we won't go into great detail, but that's typically the process. Now, once that's done, the lender orders an actual appraisal, which is to make sure that the price you're paying for the home is correct and that you're not overpaying. And there are protections in your contract to protect you against paying more for the house than it's actually worth. Most folks, especially buying a home for the first time, will want to get a home warranty, and typically these will protect against the major appliances like your HVAC, for example, if they go bad, so that they can be repaired or replaced without having to pay the entire amount. Then you would do a pre-closing concept where you would do a walkthrough of the home right before closing, make sure everything's still correct and right, and then you would go to closing. Now, I know that's a lot to take in for one quick slide, but that's pretty much the basic process. So some key questions are things like, how much payment can I afford? Now, what's important to think about is if you're renting, for example, and you're renting for a certain amount per month, when you buy a home, you might want to consider either keeping the payment close to that or less. You don't have to, but when you buy a home, there are things you have to do that you would not do as a renter. For example, typically when you rent, you don't have to repair anything. If the toilet breaks, you call your landlord. If the HVAC breaks, you call your landlord. You probably don't even, well, some of you might have to pay to cut the grass, or you may have to buy your own lawnmower, but others may not. So when you buy a home, you have all of those expenses that are now on you. Not to mention that you want to maybe fix it up and you want to put some new blinds in and, buy a new refrigerator and things like that. So you want to be careful that you don't try to keep the payment the same or higher, not knowing that, by the way, you've got other expenses that are going to come up as well. Of course, you want to think about what type of home am I looking for. For example, a condominium or a townhouse might be better if you don't want a lot of, upkeep. You don't want to deal with a yard. You don't want to deal with a lot of maintenance. Single family homes, of course, you might have a big yard and have to buy a riding lawnmower and pay for the gas and things like that. So you want to think about those things. How long do you want to be in the home? So typically when you buy your first home, you want to think about, do I want to be here for 30 years or for 20 or for 5? And that's important because it's an investment. But if you're not in the home very long, you may not get your money back out when you sell. So these are things to think about. Also, of course, school systems are important and things like that. So you want to share all that with your real estate agent so that when you get into that part of it where you're looking for homes, they're going to ask you lots and lots of questions. Zip codes, school zones, how many children do you have? Do you not have children? Do you have pets? And all of those things will factor into the type of home that you'll want to buy. So first step, of course, is getting pre-approved. So getting pre-approved basically consists of getting your documents, your W-2s, your pay stubs, your bank statements, pulling credit to make sure that you can get approved for the home you're buying and the mortgage you're going to inherit. So we're going to get into that in a minute, but we'll go to the next slide. So when you think about how much home you can afford, I want you to be careful about a lender telling you, hopefully us, hey, here's what you qualify for, but it may be higher than what you actually want to pay. So the amount you qualify for could be higher than what you want to pay. And you want to be very careful to stay very strict to your budget and not buy a house that you can technically be pre-approved for, but you may not want the payment that goes with it. So we'll talk about that in a bit as well. So part of the process in getting pre-approved, of course, is your income, your assets, and your credit. So let's talk about credit for a minute. So in terms of credit, of course, you want your score as high as you can. Now, some programs are not as credit driven. Some of the first-time programs allow for credit scores that might be lower than some other programs, but you want your credit to be score to be as high as you can, and you want to make sure you try to maintain that score and pay attention to keeping good credit. So one of the things you can do for keeping your score up, number one, no matter what you have, whether credit cards or car loans, installment loans, make sure everything's paid on time. Now, when I say on time, so there are two types of paying on time. Number one is if it's due on the 1st and you pay on the 2nd, it might be late and you incur a fee, but it does not mean it hits your credit. So creditors, as a general rule, will not hit your score unless you're 30 days late on that payment. Now, I'm not encouraging you to be 15 days late or 20 days late to incur a fee, but if it's due on a certain date and you pay after that date, the credit score itself will not actually be affected unless it's 30 days past the due date. Now, you still might have to pay a fee because you're late, but it won't affect your credit. Number two, if you have any type of collections, you want to pay those off. Those collections might continue to be hurting your score over time as they do report monthly. So if you have any collections, just pay them off, or if you can, you might be able to negotiate with the creditor to pay less and still write the rest off. Either way, you want to get them off your credit so that it does not continue to hurt your score over time. So the big one after the first two is credit card balances. You want to keep your credit card balances under 25% of the limit. And the reason for that is that unlike regular loans, like car loans or personal loans, credit cards have a special scoring model. So here's an example. If you have a credit card with a limit of 1,000, you can see there are different zones where your balance is in. If your balance is above 75% of the limit, it actually is a score hit. You're paying it on time, you're getting your 3 points for paying it on time, for example, but there's an extra sort of scoring piece that goes with credit cards where if the balance itself on the day it reports, not the day before, not the day after, but whatever day it reports, which is once a month, if the balance is high, it actually is a score hit. Now that doesn't seem fair. I mean, gosh, David, I'm paying it on time, so why am I getting penalized for that? Well, unfortunately, when the credit scoring models were created, they created the software to do that. So if you have a credit card with a high balance, it's probably dinging your score even though you're paying it on time. So if you kind of take a look at this, you can see that as you go down the zones and keep the balance lower and lower and lower, you go from getting potentially hit to less hit to getting bonus points to getting big bonus points. And so credit cards, going back to the last slide, if you keep them under 25% of the limit at all times, you will actually get bonus points on your score. And so whatever your score is, it will rise faster than any other thing you do. Paying off collections is great. It will stop the bleeding, so to speak, but it will not gain you points. Keeping everything paid on time is great, and it will give you points. But the credit card balances are the key, and those are the ones that can give you extra bonus points above and beyond the normal points you would normally get. But that's only if you keep the balance low. So that's kind of a very, very important thing to think about when it comes to score. Let's talk about down payment. Now, there are many products in the market. Some require down payments, some do not. And so let's kind of go through those for a minute. So these are generally the main products that you see in the market. These are generic in the sense that every lender generally can offer these. Each of them have kind of their own uniquenesses to them. So for example, conventional loans would require 3% or more down. FHA loans would require 3.5% down. Then you have three first-time products that do not require a down payment, but they're unique to the situation. For example, VA mortgages, which stands for the Veterans Administration, is a zero down product, but you have to be a veteran. And you have to either be a veteran that's active duty for a certain amount of time, you have to have been on active duty for a certain amount of time, or you could have been honorably discharged, or you could be retired, or you could be medically retired. So if you fit that category, this is a great product for zero down, whether you're a first-time buyer or not. Now you can put money down on a VA mortgage, but you're not required to, as long as you meet the requirement. Then there are what are called USDA mortgages, which stands for the United States Department of Agriculture. They actually do guarantee certain loans, and so these are also a great product for zero down. However, they have designated rural areas. So these are areas that would not be typically in the major cities like Newport News, Hampton, Poquoson. However, if you're in areas like Isle of Wight County, parts of James City County, and all of Gloucester County, things like that. If you're in an area that the United States Department of Agriculture has determined is a rural zone, that is a great product, great first-time buyer product, zero down, but you just have to be in that zone. Now, the next one is called VHDA, which stands for the Virginia Housing and Development Authority. And that is a state run company. It's only in Virginia. It is also has a zero down option. As we go through these, you'll see each applies to different scenarios. So if you're putting money down, maybe these are the best ones for you, conventional FHA. You can put money down on these as well, the VAs and the USDAs and the VHDAs, but you're not required to. Now, some of these products, as you can see, USDA specifically and VHDA specifically have income limits. So in these two products, they were originally created for the idea that a person who did not, or a person who fell underneath a certain income level would be qualified for those products. So if your income is higher than what USDA or VHDA allow, and it's based on family size, so one person's a family of one, a person and their spouse or significant other and 3 children is a family of 5. So these income limits are different based on your house size. So USDA, it has a geographical restriction, and USDA and VHDA together have income restrictions, and we can help guide you through all that. Some loan products allow for grants and down payment assistance. The ones that do also have additional income limit restrictions. So this is where when you get pre-qualified and you tell your loan officer, hey, I'm a first-time buyer, here's my income, here's my assets, pull my credit, etc. That loan officer will help guide you on which one of these products is the best fit, which one of these products will give you the best payment. And depending on your income and depending on the geography, you may or may not be able to access all of them. For example, if you're not a veteran, you can't do a VA loan, a VA mortgage. If you are not in a designated rural area, you could not do USDA. If your income's too high, based on your household size, you might not be able to do USDA or VHDA. So the products the product you're going to wind up with is likely going to be whichever one fits you the best, and your loan officer's job is to try and determine, based on your situation, your income, your family size, whether you have money down, whether you don't, whether you're a veteran, whether you're buying in a rural area, etc., which one of these is going to fit you best that you can fit into and get the best mortgage and the best mortgage program and the best mortgage payment. So going back to grants and down payment, there are some grants in the industry out there, and they apply to certain types of loans. We're not going to go into great detail about which ones, but generally, there are some grants that will apply to all loans, and there are some grants that will only apply to certain loans, like VHDA, for example. So let's talk about the loan process. So when you first get started and you apply, generally speaking, what a lender's looking for is, first of all, income. Let's talk about income for a minute. So generally speaking, lenders want to see or are required to see your 2-year recent work history. So as a general rule, and there are some exceptions, but generally speaking, you need to have a 2-year consistent full-time income. It can be hourly, it can be salary, it can even be commission. And how the lender qualifies you on that is a little different based on how you get paid. But you do need to have a 2-year, generally speaking, we'll talk about some exceptions. Generally, you need a 2-year full-time employment history. Now, does it need to be with the same company? Not necessarily, but it does need to generally be in the same industry. For example, you worked for a year at company XYZ, and then you moved to another company, but you were doing the same thing. That's perfectly acceptable. Now, some of the exceptions to this would be a person who graduates from college with a teacher license and then goes to work in a school system as a teacher. They would not necessarily need a 2-year history. They would use their college as part of their 2-year history of work. Even though it's not actually work, it was leading up to their job. So these can vary a little bit, and it's important that when you go to get pre-qualified, these are the things that the loan officer is going to go over with you to determine your work history, the consistency, etc. The things that can be challenging would be things like you worked for a job for 2 years making a salary, and then you left to work for another company making commission. Well, because commission is not guaranteed, that could create a problem, and you might need to have 2 years consistently working in a commission position to prove that the commission that you've been making is consistent. They'll also ask you for bank statements, and the purpose of that is twofold. Number one, to see what your direct deposits are to make sure that the income you're earning is depositing in there. Number two, to make sure there's no potential issues. Maybe a lot of non-sufficient fund situations, things like that. But they will ask you for those to make sure to see what your assets are. Now, while we're on that topic, some programs require that you have a certain amount of money in the bank. 2 months worth of mortgage payments, 3 months worth of mortgage payments. So if your mortgage payment is $1,200 a month, you have to prove that you've got 2 or 3 months of that in your bank. Some programs do not require any money in the bank. But here's the thing to think about, and this is not about the qualifying part, but about the real life part. You want to be careful because when you buy a home, you are stuck with that payment. That is a payment you cannot get out from under. So you want to be careful because you want to make sure you have enough put away for emergencies. Maybe the hot water heater goes bad and you got to run down to Lowe's and buy a brand new one. And then your riding lawnmower goes bad and you got to buy another one of those. So you want to be careful that when you buy a home, please make sure you have done your best to put away as much money as you can, even if you need no money down. So even if you're buying a house and getting a VA loan or a USDA loan or a VHDA loan or one of these, but getting a grant maybe to cover this, please be careful that you don't walk into that house and are not prepared for the inevitable expenses that come from owning a home that you weren't expecting. Maybe you bought a house and you even got a home warranty, but the HVAC went bad completely. Well, even with a home warranty, you still got to pay something, to replace it. So just be careful. If you're a veteran, the loan officer will require that you show your DD-214, which is your retirement document, or if you're active duty, a statement of service to show you're still active duty. And that'll help them make sure that you have the full VA eligibility and entitlement. If you're self-employed, typically, of course, because you're self-employed, it's not the same as a regular paycheck or a W-2 job. So your loan officer is going to want to see 2 years business tax returns and 2 years personal returns, depending on how you file. Once you've gathered all this, the loan officer's job, after helping you figure out what program works, what's the best one for you, do you need a grant, do you need a down payment assistance, etc. Once they've determined that, then the very next step is to submit your loan, get it fully approved, and of course from there, as we shared earlier, you're going to go from there to writing a contract, ordering an appraisal, and then of course you close. Now that sounds very simple. It's not. It's a little bit complicated. There's quite a bit to it, but the process is generally the same. Additional items, you do have a sales contract you'll have to write. And this is, again, why it's important to use a real estate agent. If you're writing a contract by yourself, these contracts are very thorough, very detailed. They contain a lot of protections for both the buyer and the seller. And because it's a contract, I would advise highly to almost anyone I would speak to, make sure you have a real estate agent whose job is to use that contract and write it properly. I kind of look at it as like in a courtroom. You wouldn't go to court unrepresented. You would have an attorney. They're the expert. They are representing you in the transaction. In the same way, you normally would not want to buy a home and enter into a sales contract transaction with a seller without representation. And that's why an agent is so important. Of course, you'll typically put down what's called earnest money. So you've decided to buy house XYZ on 123 Main Street. You're excited. You write your contract, and with that contract, your real estate agent's going to ask you for two things. Number one, you're going to need to provide what's called an earnest money deposit. What the earnest money deposit is for, it's your good faith that you intend to buy the home. So typically, this could be $500 or $1,000. Now, this is not a fee. This is money that will apply towards whatever is due at closing from you. So for example, if you give them a $500 earnest money check, which is the good faith deposit to the seller that shows I am serious about buying your house, and here's my $500 to be deposited with the attorney that's going to close the loan, they will hold on to that money. If you were not due any money at closing at all, if the seller is paying all of your closing costs, if you were getting a zero down loan, you would actually get this back. On the other hand, if you had money that was normally due at closing, that money would apply to it. So it's not a fee. You don't lose this. It's simply the earnest money or the good faith deposit that you're giving with your contract to the seller. The seller's not keeping the money. That check goes to the attorney who's closing the loan, and they hold it. Then from the process is the home appraisal, which we talked about for a minute. So the appraisal is looking for two things. It's not a home inspection. Your home inspector's job is to find out every little thing about that house, good, bad, indifferent. And from that, you may or may not ask the seller to fix things based on that home inspection. The home appraiser's job is to determine, is the house worth what you're asking, what you've offered. So you've just put an offer on a house for $200,000. The appraiser's job is to determine, is that actually worth $200,000? If it is, or if it's worth more, wonderful. However, if it turns out the house is worth less, that's where your sales contract comes in, and there are protections to protect you against overpaying. And again, that's exactly why you want to use a real estate agent, because they know all of those ins and outs of the contracts and the protections they provide. In a home purchase, just like you would buy a car, in a sense, there is a title search. So when you buy a car, for example, you don't buy a car unless the title is clear. So that when you buy that car and that the seller hands you that title and you go to the DMV with it, is a clear title. There are no liens on it. There are no encumbrances on it. There's nothing else to prevent that car from passing to you clear. Well, homes are the same way. So you go buy a home, you've written your contract, you're into your process. Your title company is going to do a title search. they are going to determine, are there any issues with this title? Meaning, maybe the seller owes the IRS money and there's a lien against the house. Maybe there's a judgment against the house. Maybe there's a mechanic's lien against the house because the seller did not pay a contractor when they fixed their house up. All of those things will come up in the title search and protect you to make sure the seller has to satisfy those items before title passes to you as clear title. Title insurance is the insurance that protects against that in case there's something that was unknown or invisible. So all of these pieces are all designed as you're buying the largest investment of your life, which is your home. They're all designed to protect you. And again, it goes back to make sure you have an agent with the right, so they can write a proper contract. And as they go through this process, all of these items are there to protect you. Of course, you would get homeowners insurance, which is you've seen the commercials from State Farm and Nationwide and Progressive, etc. And so homeowners insurance is to protect against anything and everything that could happen to your home. For example, there could be a fire, maybe the roof gets damaged in a storm, maybe your house has a leaky pipe and it floods the first floor and damages the floor and all the items on the first floor. Homeowners insurance, like car insurance, protects against those things and will replace those items. Flood insurance is only needed if you happen to be in a zone that is determined by FEMA, the government insurance agency that oversees flood insurance in the country. Only if you're in a flood zone where it's required would you actually have to get it. Now, one thing you want to make sure of, that when you're looking for homes and you're working with your agent, as you look at homes, sellers are typically required to disclose whether they are in a mandatory flood zone. And that would alert you to, oh, wow, if I buy this house, I'm going to have to get flood insurance. Now, there's nothing wrong with buying a house in a flood zone. There's nothing wrong with getting flood insurance to cover the possibility of there being a flood, or you're in an area that would flood and therefore damage your house and ruin part of your house. That's perfectly acceptable, but you need to know that going in. It should not be a surprise. And once again, goes back to your agent. Your agent's job is to find out in advance if a particular home is in a flood zone that would require that. After you've gone through this process, you've written the contract, given your earnest money, the lender has processed your loan, you've got a home appraisal that's been done, the title search has come back clear, you've got your homeowner's insurance set up, you may or may not need flood insurance, then you finally close. And that's the last stop. So that's the day where you walk in the door, you sign all your loan docs and your closing docs, and you walk away with keys, and you are now a homeowner. So I'm going to kind of recap this because I did move kind of fast. We're going to go through it one more time. Number one, define your needs. What do you need? You need 3 bedrooms. You need 2.5 baths. Do you need to be in a certain school zone? You absolutely want to get pre-qualified before starting the home search. So if you're in a lease and it's expiring at a certain time, let's talk about the timeline. When you buy a home, the typical processing timeline from the day you go under contract to the day you close is probably up to about 45 days. It can be faster, but that's a good timeline to be thinking about. So when you write the contract, from that date to the day you're closing and getting the keys and walking into your new house, it's about 45 days. However, the one thing that nobody knows is how long will it take to find one, and how long will it take to get one under contract. This is a market right now where the sellers are generally a little more in control because there's not a lot of homes on the market compared to the amount of buyers that have a demand to buy those homes. So as a result, homes tend to be selling very quickly, and as a result, homes tend to have more than one offer. So you may find, you may not, but you may find that as you get yourself together, get pre-qualified, you've picked your agent, now you're ready to go. Let's go find a house. It could be a challenge finding one quickly if the ones you're looking at are highly sought after and have multiple buyers wanting them. And so you could find yourself in a situation, you might not, but you could find yourself in a situation where you went to look at a house, you fell in love with it, you wrote an offer, and the seller said no because they got a better offer from somebody else. So you dust yourself off, no big deal, I'll go get another one, and it happens again. My point is that if you're in a situation where you have a timeline, maybe your lease is coming up in 6 months, I would not encourage you to wait until you had 60 days left on your lease unless you are willing to go month to month, because you might find, you might not, but you might find that you get 60 days away from your lease ending, you hop in the car with your agent, you go start looking at homes, and it takes you 30 days to find one and get one under contract, or 45, because there are so many buyers out there and not enough homes to go around. And so that's important to think about, not to discourage you, but you want to build that into your timeline and consider the possibility of looking sooner rather than later. Now, if you have a situation where you don't have to move, or if your lease runs out, you can go month to month and it's not a big deal, then it probably does not affect you. But if you're in a situation where you have to move by a certain date, it's a drop dead date, so to speak, you might want to be careful and not wait too long till you get too close to the end of that lease and then start looking, because your timeline might get away from you, even though you thought you were doing everything right. You got pre-qualified, you called your agent, you got your agent, you went looking, but oh my gosh, we've looked at the last 5 houses and we didn't get them because somebody else outbid us. So just something to think about. Going back to this slide, just real quickly, please, again, make sure that you have thoroughly thought through your budget, assuming and recognizing that when you buy a home, you are going to have expenses that you did not have as a renter. They're just going to be there. Lawnmowers, gas for the lawnmower, new upgrades to your home, things break, hot water heaters go bad, toilets break, things like that. Light fixtures, your sink, needs to be replaced, things like that. Whatever it is, be careful and make sure that you have budgeted thoroughly. Now, there are some good first-time buyer classes that you can take, which will assist you with budgeting and some of these items. I would encourage you to do those, and I'll go into one of them in just a second. But it's very important to make sure that you thoroughly think this through and don't say to yourself, oh my gosh, my rent is X. Well, my mortgage payment can be the same, which is perfectly fine, but you have to prepare for there are going to be other expenses. The pre-approval part, the easiest way to do that is, and I'm going to share a slide here in a minute, is to either go online. We have a website right there on First Advantage where you can apply for a mortgage. It's relatively simple, takes maybe 15 to 20 minutes. You fill it out the best you can. You don't have to be perfect or exact. Once you're done, one of the loan officers here at First Advantage will reach out to you and begin the process of getting you pre-approved. They'll probably, again, going to ask you for things like pay stubs, W-2s, possibly income tax statements, but generally that's only if you're self-employed, generally, or if you have rental properties or things like that. If you're a traditional W-2 person, traditional pay stub person, you probably would not need that. But they're going to ask you for some documents that they're going to pull together to help you get pre-approved. They're also going to then, again, to go back, they're going to walk you through the different programs in the market and determine which one is the best fit for you. And I do, again, encourage you highly to start that process before you think you might need to. If you have 6 months left on your lease and you absolutely have to get out, I would be careful not to wait to the very last minute in case, number one, there are credit issues or other qualifying issues that you could fix but don't have time to now. Or if you find yourself in a bidding war trying to buy houses and everybody keeps outbidding you. So easiest way to apply is to go to our website at firstadvantage.org, click on apply for loan in the upper right hand corner, hit the mortgage drop down. You would then want to fill that out the best you can. It does not have to be perfect or exact, just do the best you can. Or you can call into our call center and they will help route you. They'll take your information, send the referral into our mortgage department, and one of our loan officers will call you. They'll also call you if you apply online, or you can just walk into a branch and say, hey, listen, I'm thinking about getting pre-approved for a mortgage. We want to buy a house. What do we do? They'll take some basic info from you. They will not take the bulk that I'm talking about, or they will not even take necessarily the stuff that you would apply. They would just take your name, your number, what you're looking to do, probably your email address, things like that, and then route you to a loan officer. All right, do we have any questions? I know I've kind of blown through this pretty quickly. I didn't want to make it so in-depth that it went over everyone's head. I just wanted to mainly cover the overview. I am excited for you all that are looking to buy your first home. I know it's a daunting thing and you might be concerned about everything that goes into it, but I would highly encourage you, when you believe that you're getting ready to start looking and ready to be a homeowner, go ahead and take the plunge. The best way to find out about your pre-approval is to find out quickly. You don't want to wait until the last minute to get pre-approved.
Great, David. I don't see any questions in queue, but if folks do have questions later, is there a way they can reach out directly to you? Oh, wait, looks like we just had one just pop in. Let me see. Do we have the slides available for download? Yes, we can absolutely make them available. We're also we have recorded this session, and so we will make it available on our website. It'll probably be up early next week. And so you can visit firstadvantage.org and toggle over to the Resource Center, and you'll find all of our recorded webinars there. So David,
Amber,
oh, go ahead.
Amber, I will add to this slide that when you post it, I will add the contact info so that everyone here on the call, you have a direct email input to me.
Perfect. And it looks like we had another question come in about what would the first step to find out eligibility for the VHDA down payment assistance grant? How would someone go about doing that?
So there's a couple ways to do it. Number one, you can always reach out directly to us and we'll help guide you on your family size and the income limits. And those are listed. The other way, and forgive me for not having this on the slide, VHDA itself does have a website where you can actually look those up. So if you'll indulge me, I can actually pull that website up and I will make sure it gets on the slide as well. So let's see if we can get that pulled up here for you real quick. I'm hoping everybody can see this, but if not, we will get this on the slide.
Yep, we can see it.
Okay. So VHDA has its own website, and I'm going to put the exact direct link on the slide because I wouldn't expect you to necessarily, sift through all of this to find it. But in the VHDA website, there is a section here at the bottom. And again, I don't expect you to be able to follow me at the moment. I'm just kind of walk you through it so you can see it. And then I'll make sure the direct link is on the slides that are on the website. So there's a place you go to right in here. And as we scroll through, there's actually a chart. And what's really great about this is it's public data. So anybody can go access this themselves. And it literally lists if you're just doing the normal program versus the down payment assistance or the grant program. Now, we happen to be obviously in this Norfolk, Virginia, Beach, Newport News, MSA, Metropolitan Statistical Area. And so in our area, here are the income limits. So if you're not getting the grant, the income limits are higher. You can see that hopefully. Let me see if I can, I may be able to make my screen larger. Yeah, let's do that. Here we go.
Hey, David, along with the income limits, we had another question come in regarding the family size. So do you know, is it based upon children 18 years or younger, or could also college students that are still dependents count towards the household size?
That's a great question. So generally speaking, and there could be exceptions, but generally speaking with the grants, family size is considered to be anyone who's a dependent. So even if they go to college, but they are still considered a dependent, they would still be considered as part of your family size because obviously even though they go to college, they come home to you. So it's generally speaking, it's anyone who lives in your house, or let me rephrase that. You would not be able to count them if they did not live with you. And live with you means that is their primary residence. So while they're away at college, they still live with you in terms of that is their primary residence. So if they're in college, now if they're in college but they have their own primary residence address, then they would not be considered part of the total. But as long as your house is the place where they reside when they're not in college, then absolutely you would count them. And as you can see, it makes a difference in the VHDA grants specifically. Now, there are other grants. Well, there's a specific grant which we're not going to be able to pull up because it's a little more difficult to get to. But you can see that the grant, or the income limits are higher for a family size of 3 than they are for a family size of 2. So family size of 3 or more, the normal limit for the household is $105,400. The grant limit income for the household is $84,300. 2 or fewer, you can see the numbers drop. So it's not going to be as, so if you have a college student, but they live at home when they're not at college, they definitely count towards this number.
Okay, great. We've also had a question come in regarding interest rates. Are USDA and VHDA usually more or less than other loan types when it comes to interest rates?
That's a great question. As a general rule, the VHDA rates tend to be about the same. USDA tends to be a little less. So let me kind of do one real quick thing. We're going to go back to the loan products, and that's a great question, by the way. So generally speaking, when you think about loan products in general, oops, here we go. When you think about loan products in general, you have your conventional loans. Those are considered non-government. So they're really not they're not integrated with a government program. These products, however, in their own way are government related programs. Actually, VHDA, believe it or not, is not one. It used to be, but it's actually a private entity now. The government programs, as a general rule, FHA, VA, and USDA, generally speaking, have rates that are slightly lower than conventional non-government loans, and they tend to be slightly lower than VHDA. So conventional would be a little bit higher, more than likely, than VHDA, which would also be more than likely a little bit higher than the government products, which is your FHAs, your VAs, and your USDAs.
Okay, and then it was back on one of the charts you were looking at. There's a question regarding what does the new and existing construction column mean?
Let's go back and find that. Let's see.
I think it's probably just referring to if the property itself is new construction versus existing, meaning, you know, it's already been built and there's a little less risk there as far as it being built.
So let me see if I can find the question really quickly. Was it? Let's see. Here we go. New and existing. Okay. So new and existing construction simply means new construction. And thank you, Cindy, by the way, for that question. So new construction would be, typically like a subdivision that's being built. These are brand new homes. You walk into the model home and you pick your model and they build it for you. Or they may have built one already, but it's still brand new. No one's ever lived there. It's a brand new home. Whereas existing construction would be something that someone's already lived in. And we also use the term resale. So someone's already lived there, could have been a year, could have been 25 years, could have been 100 years. That would be existing construction. Now, in terms of the difference between the two, you can get, let's go back, you can actually get any of these products on a new home or an existing home, as long as the builder of the new home will accept your contract with one of these products, which they should. There shouldn't be a reason they wouldn't, but as long as the builder of that new home will accept your contract with the product that you are telling them you're going to get, then it would not be any different than if you're just buying a home from someone who already lives there and they're just selling it. And in that sense, all of these products are available for new construction or existing construction. So whether it's brand new with a builder in a subdivision, or whether it's an existing home that someone's lived in for a year or 100 years, you can still get all of these products for those. And the only exception would be if for some reason, and I would not say that this would be typical, but if for some reason that I can't think of at the moment, but if for some reason the builder and or seller would not accept a contract with the product, that would be the only possibility. But in terms of qualifying, any of these products will allow you to buy that. Yep. All right.
All right, so we had a great question come through about PMI, and they noticed there was no mention of PMI, and we're wondering if that's because First Advantage does not require PMI on our loans, or if we have loans that do not require the recommended 20% down for the PMI.
That's a great question. So PMI, for those who might not be familiar, is a term called private mortgage insurance, and it's simply a cost that becomes part of your payment when you're not putting 20% down on your mortgage. So let's kind of walk through each of these real quickly. Generally speaking, you got your conventional loans. This particular product does not require PMI or private mortgage insurance as part of your payment if you're putting 20% or more down, which would not typically be what you do as a first-time buyer, but you could be buying your first home and have your 20%, or you could have a parent who said, hey, I don't want you to have that as part of your payment, so I'm going to give you the money. So this particular one, you would not have to have this PMI or private mortgage insurance if you put 20% down. However, FHA, because it was never designed for large down payments, you would still have it. VA mortgages do not have PMI monthly. Instead, they have a thing called a funding fee. And forgive me for all this vocabulary, but they have a thing called a funding fee where they do not charge it monthly, they charge it up front and put it in your loan as a whole. USDA would have PMI, and generally speaking, most of the VHCA mortgages do. There is a type of VHCA mortgage where you can build it into the rate. It would not be part of your payment, but it would be part of your rate. The rate would bump up in order to get rid of it. And thank you, by the way, for that question. And yes, you're correct. We did not mention PMI, but private mortgage insurance is part of your payment, generally speaking, unless you put 20% down on conventional loans. So, for example, and you probably appreciate that. So, what we're going to do, I'm going to take a quick look. Well, I'm trying to find it. What we're going to look at really quickly is an example of mortgage payment. Maybe I shouldn't be doing this because of the screen's showing up, so I'm going to just drop back out of that. So PMI is only required on certain loans, but not on all, as part of your payment.
Okay, great. Thanks for that explanation. The next question is regarding, do you know if a prior reservist service would count towards a VA loan?
It can, and it really depends on how long you were in service. VA has specific requirements for how long you had to have been in the reserves or National Guard, and for that matter, how long you would have had to have been active duty as well. The best way to find out is to get a certificate of eligibility directly from VA. We can do it for you, or we can help guide you on how to get it. So this would be one I would say, if you wouldn't mind, when we post the PowerPoint slides, I will put my contact info. All you have to do is reach out directly to me, and I will give you instructions on how to actually get it. And that's the number one foolproof way to make sure that you had enough prior reservist service or National Guard service to qualify, because they do have a minimum amount of time that you have to have been in. I refrain from sharing what that amount of time is only because over the years, VA has occasionally changed it. And so I don't want to give you an arbitrary timeline without knowing your full circumstances.
All right. And the last question we have in queue right now, it states, why do sellers not want to accept certain types of loans? Do sellers, quote unquote, look down on a contract if the potential buyer is using a down payment grant or assistance?
It's a great question. I've never actually seen necessarily a seller look down on a contract with a grant. I do know that, as an example, if a person is offering cash for a property in a contract, that might be something that would sway the seller versus wanting to take a contract with a product. Only because a cash buyer is likely to be able to, stroke a check and just buy the house in a week and a half and be done. Whereas the person coming in with a loan program, which is normal, cash sales are not the norm, they're the exception. But a person coming with a loan program, the seller realizes, gosh, it's going to take, 30 to 45 days to close. And so they may or may not want to wait that period if they had a competing offer with a cash offer. I have not seen specifically where sellers would look down at a particular product per se. I just know that they would probably typically favor a cash offer over a person having to go get their loan. And what that speaks to, let me go back a second. So historically, in these products, some of them have a little bit stricter appraisal requirements, like VAs typically tend to be a little more white glove treatment when they appraise the home. And so there was a time years ago where sellers were reluctant to take VA contracts because they thought that the appraiser was going to come back with a bunch of repairs that they were not willing to do, and they thought that a conventional mortgage or an FHA might be more lenient on the appraisal. I have not seen that recently, so it's not something I would worry about when you're buying a home, but it's possible a seller could choose, more than likely, for example, a cash offer over one with a loan.
All right, it looks like we are caught up on questions. Thank you. Oh, just kidding. One more just came in. Oh, no, just a thank you for the information. Well, I will echo that, Sharon. David, thank you so much for all your information this evening. You're just a wealth of knowledge. And for everyone still on the call, we will make this available, the recorded version, on our website early next week. And if you have any questions in the meantime, please reach out. As David mentioned, you can always reach out through our website, through our call center, or by visiting any branch. We hope you all have a good night, and thank you so much.
Thank you.